The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today is editor John Addis. Hey, John.
Morning, Gaurav.
With us also is senior analyst Graham Witcomb. Hello, Graham.
Hey, Gaurav.
Now, gents, we're all old enough to remember a day, I'd say it'd be almost 20 years ago now, more than 20 years ago, maybe 30 years ago. Telecom Australia became Telstra. The local market was opened up to competition, and Optus first came to our shores. Do you remember that day, John? Were you in Australia? Do you have any recollection of it?
Yeah, I do. That was before I came to hate them, but I was quite encouraged when they first arrived.
I remember thinking that this was just some incredibly high-tech new startup venture. You know, they had branding that was completely different. They did wall-to-wall advertising, and they just seemed so much cooler than Telecom Australia. And I was young at the time, and they were.
Yeah, I was going to say, how many 10-year-olds are thinking of?
We all know Gaurav's a bit weird like that.
I was eating ice creams from McDonald's at that age, not.
I remember looking at those ads thinking, wow, this company seems cool. I have that distinct memory, and it didn't last very long. Optus has been in Australia now for, I think it was 30 years, right, guys? It's been decades, and it's grabbed lots of market share, but I think we can successfully claim that it's been a bit of a flop. I think they do broadband and mobile, and I'm not sure if they have enterprise services or not, but let's stick to broadband and mobile. In mobile, they have a decent quality network, and they do make money. I think they have 6-7 million subscribers on that network. In broadband, they have sort of 14-15% market share. It's collapsed since the NBN was built, and how much money do you reckon they make? Any takers?
I don't know. Not much.
Okay, so Optus, after being in Australia for decades, after launching a successful mobile business and taking acceptable market share of the broadband market, make about $250 million a year. That sounds like a lot of money, I suppose. But when you consider how much money Telstra makes, which is sort of billions of dollars a year, I think, and then think about the sunk capital that's gone into Optus. I'm happy to call it, gents. I think Optus has been a complete failure over the years.
Yeah. Well, we all knew it was a technological failure. I didn't realise the financial failure was as bad as that.
You think it's a technological failure?
Absolutely. I don't think that. You look at their website; it's horrendous. They stuffed up the World Cup.
Yeah, that's true.
I still get buffering when I'm watching Premier League. They couldn't deliver a reliable mobile service, not even able to call emergency services. I think they've been poor at technology ever since the day they arrived.
I remember many years ago now trying to get the internet connected from them, and they came to my place and they connected it to the wrong unit. Then I called them back, tried to get them back again. A couple of weeks later, they come back, reconnected it to a different unit. And I then had to get them back a third time. And at this point, I was very, very lucky that the technician had given me his phone number because he was going to call me from like in the box area, wherever they do the connections, to actually check that it was working. And but then it cut out. They again connected it to the wrong unit. And then I kept harassing the technician. And eventually they just stopped responding altogether. So then I moved to, I can't remember who, I think it was TPG. But just such bad service. I tried for more than a month to get this connected and couldn't get it. They couldn't do it.
Yeah. Is that the story of why you really left the country? I think it might be.
Yeah, I decided to flee. I thought
after that experience.
Yeah.
The telco's crap. Let's move.
They're not better here. It just seems to be something about telcos worldwide that they can't do customer service.
Well, the reason we bring up Optus, in case anyone's wondering, is that here's a business doing $8 billion of revenue, $250 million of profit with enormous asset value, huge historical capex. And there are rumors flying around that Brookfield is going to be bidding for it. And it looks as though Singapore Telecom, which owns a big stake, if not all of Optus. I can't remember what the ownership structure is like, but they have confirmed that they're looking at at selling it off, or at least a kind of a strategic review of Optus. And I just think that is a incredibly important development in the domestic telco industry.
Why is that?
Well, Telstra, I wrote this when I wrote up Telstra in its for its half year result. But there lies a truly staggeringly dominant monopoly in front of our very noses, and it never gets commented upon. I'm shocked. I mean, we spoke about the supermarket monopoly in inverted commas. That gets complained about. Qantas gets complained about. The banks get complained about. But it's Telstra that really takes the lion's share of industry profits. I think they take something like 80-90% of industry profits.
Yeah.
They have 50% market share in broadband and similar, if not more, in mobile. This year, they will overtake Rogers of Canada to be the highest EBITDA margin mobile operator in the world.
Incredible. So they're like the Apple of the mobile networks rather than the handsets.
Yeah, I think that's right. The financial results out of the mobile business is truly fantastic. And it means that Telstra can afford to make errors in capital allocation and in strategy, which they have done with
repeatedly
with glee over the last 20 years. But they're always
getting
covered.
Their hands dirty.
Yeah. They're always covered by this amazing mobile business. And the reason why Telstra Mobile can be so dominant and it can be so profitable is because the two competitors, Optus and Vodafone, are woeful. Vodafone, I actually think, is going to leave. I can't see that business ever being profitable in Australia. And I think there's a good chance in 5 years' time that Vodafone just packs up and leaves Australia, because I don't see a path to profitability for that business.
Hasn't it always been kind of on the edge of leaving? That
you could have said that 15 years ago.
Yeah. They seem to just hang in there.
Yeah. But I think Vodafone Global now is probably can't carry Vodafone Australia. And I think they've always held up some hope that they will become profitable, but I can't see that happening. And you've got TPG now in there as well. So it's a listed entity now as well. And you can see very openly how much money they're bleeding in telcos and how unprofitable that business truly is. So I think there's a high chance they leave. And Optus being sold to a proper management, and Brookfield is one of the smartest asset owners going around. They have a lot of history. They bought Vodafone New Zealand when it was a bit of a basket case with Infratel. And that was one of the key reasons we actually recommended Infratel and made a multi-bagger out of it. And they turned that business around completely. And I think if they get their hands on Optus, I think there's a fundamentally decent business there. It just has not been very well managed over years. And it'll be interesting to see how that plays out. I think the change of control in Optus may force the departure of Vodafone, because a lazy Optus has allowed Vodafone to kind of stay in business, where probably the economics dictator probably won't. So this is my prediction. I reckon if Optus changes hands, if Brookfields or a properly motivated and incentivized management take it over, I think they squeeze Vodafone out and Australia becomes a two-party telco, and Telstra maintains its dominance, perhaps even increases its dominance, and Optus then is able to generate better returns as the number two, and that's what we get. We get two players in mobile, and you've got a whole host of independents in broadband as well, like Aussie Focus, Superloop.
Yeah.
Huge
Do you think
implications
Optus
for the
could buy Vodafone, or would the ACCC kind of prevent that, even if they are kind of both failing?
Yeah, no. The ACCC would never allow that. One of the key tests for the ACCC now is what merger activity does to competition. They measure something called the concentration ratio, which is how much market power the top few market participants hold. And a merger between Optus and TPG will just fail on all their numbers. And I can't imagine that they would have let that go through.
It's just in that when you've got high capital intensive businesses, there is a kind of natural way that competition plays out that tends to lead to either 2 or 3 dominant players. And in the mobile market, I think that would happen if the ACCC did block that merger. You'd end up with 2 companies no matter what, probably.
Yeah, I think you're right.
I've always thought the same, that the test should be slightly different for these kind of businesses, where if it's cascading towards just a single monopoly, then they're kind of better off at least supporting one other. But I guess it may be considered, I don't know, selective advantage or something or other, where they might as well let the 2 failing competitors merge to have some hope of there being at least a duopoly structure that establishes and gives a little bit of competition.
So here's an idea for Gaurav then, because what we've done with the broadband network seems quite sensible. So you have one entity, which is effectively a government-owned entity, that regulates the infrastructure and then sells wholesale access to it, which allows competition at the retail end of the pipe.
Yep.
What if we nationalized Telstra and made that the network, and then you just do in the mobile network what we've done in broadband?
Yeah. I think it's different because the NBN is a point-to-point fiber business. So you lay all these pipes down once, and then you don't really need to lay additional fiber to increase capacity. You can actually increase capacity lots of different ways with fiber. Whereas with these mobile towers, you really need a private sector to invest in towers to keep up with demand. So Telstra, for example, invests, I think, 16, 17, in some years, 18% of its entire revenue on mobile towers to keep up with the demand.
Right.
And I don't think a government entity would be incentivized to do that.
Yeah, it's
what
not
they
a
should have
toll
done,
road situation.
Yeah. What they should have done was when they privatized Telstra, it should have been split up the way New Zealand did. Should have been split up into an NBN business, the copper wire fiber business, and then the retail component. And I'm not sure why they didn't do that. That seemed very obvious at the time. But there you go, revolution in the telco business potentially happening. I think it's these kind of big changes are important to keep a grasp on, because I think often when something changes, the market is slow to catch on. The market's very good at straight line extrapolation and thinking about trends in a linear fashion. When you get a break, when you get a change, that's when you often get opportunity, because that's when there's increasing uncertainty. And I'm convinced the market doesn't know how to deal very well with uncertainty. And so that's how you get mispriced assets. So I'm actually looking at this in this industry now with a bit more interest. And we'll see what happens with this sale. But I think there is a good chance we get some mispriced assets as the industry is upended, which I think is the inevitable end to the debacle that has been Optus. I mean, I'll just repeat again: an $8 billion revenue base and $250 million in profit. I think Aussie would do 100 million or so.
Wow.
This year.
Wow.
And they have a lot less than 8 billion in revenue. It just shows, I don't know what's going on in Optus, but it's just been colossally poorly managed.
It does make you wonder about Temasek, because I've always seen that it's basically a sovereign wealth fund, Singapore sovereign wealth fund, as quite an active and capable manager. What little I know of it, but they just don't seem to have been active in Optus at all. Or if they have, they failed to turn it into something anywhere remotely as good as Telstra.
Yeah, it's interesting, because Singtel, which is the key owner of Optus, they run a very good business in Singapore. And as you say, professionally managed. You wouldn't guess that they'd run such a lousy subsidiary in Australia, but
no.
Yeah. And in fact, the individuals involved in Optus have all been really high caliber as well. Really well credentialed, very good experience.
Maybe it just shows the value of being the largest. No matter which country you're in, how good the managers are, just being the big guy counts for a lot.
I'll propose something different. I think what the advantage that Telstra has was that was primarily an engineering-led company right from its very origin, and that culture is probably very much established, although I imagine some CEOs have tried to minimize its influence. And it's a lot easier to get better at marketing than it is to get better at the technology or the engineering side of the business. And Optus, I think, was primarily a marketing-led organization. And we saw that in the advertising when it launched. And to me, the engineering and technology side, they just absolutely fail at. And it's more important to get the technology right first than it is the marketing, because the marketing you can fix up. The technology side takes a lot more effort and it's much harder to do culturally, I think.
I think that's fair. I also would point to Optus's market behavior. When you think about the companies that have really succeeded in telco, TPG and Aussie Broadband are the two ones that come to mind. They came to market with a very clear, deliberate strategy. So TPG was the price leader. They came in when no one could match their costs, and they just took market share with lower prices. And Aussie went the other way. They just went on better service and higher prices. Whereas Optus, they never really behaved like a challenger brand. I think they tried just to be another Telstra, a very big, cost-heavy, high unit price provider, rather than trying to take market share from Telstra or disrupt it. I think the culture. I think we're saying the same thing here, John. Is that culturally, Optus was not the right business to come and challenge Telstra from the beginning.
No, I think history's showing that. Right.
Well, telcos. One of these days, Graham, I would love to hear your take on Rogers, because Rogers is for a long time, Rogers is a mobile operator in Canada. For a long time, has been the highest margin mobile business in the world, and that crown, I think it's going to fall to Telstra this year. We'll see how the numbers land, but I think it's going to be overtaken. But that's an incredibly successful business, and might be worthwhile talking about that one day.
Yeah, it kind of surprises me that Telstra is able to earn just as much as it. Well, actually, maybe the other question is why Rogers can earn so much, because
that's right.
I feel like I get the impression it's a more competitive market here, that there are kind of 5 big telcos or so.
There are 5 telcos, are there?
I think there's incredible. At least 5. Yeah, they might be piggybacking on each other's infrastructure. I'm not really sure, but I just get the impression from a retail perspective that there's a lot more competition here.
Yeah. Okay. Well, that's
I don't think we pay different prices, so it doesn't seem to work.
That's a discussion for a different day. I'm looking forward to that, Graham. Let's have a chat about that at some stage. That'd be very interesting to go through. John, I'm really interested to hear that you are writing a book.
Well, I'm trying.
We've seen a few chapters. It's looking really good. But what's more interesting is that a lot of times when investors turn their hand at writing, particularly books, it's usually a boast. And you've actually gone the other way, and you're writing a book about intelligent investors, many mistakes over the last 20 years. We're going to talk about one of those mistakes.
It's a long book.
It's a long book.
This is just the first of 5 volumes.
We're going to talk about one of those mistakes in a moment, but just give us the psychology of why focus on errors.
Well, a number of reasons, I suppose. The first thing is I think you become a far better investor from analyzing errors than you do successes. And the second reason is the maths, really. If you can just minimize your errors and hang on to attractive businesses that you've purchased at reasonable prices, you'll do far, far better. But our psychology is such that we're driven towards the big winners. Everybody's looking for the next Afterpay or the next NVIDIA. And I just don't think that's a sensible way to go about it. I think the best way of doing it is to try and minimize your mistakes. And the mistakes that I think we make fall into 4 broad categories. So the first one will be the stocks that we buy and then sell too late after they go bad. The stocks that we buy, which we sell too soon. And the stocks that we shouldn't have bought in the first place. And the stocks that we didn't buy but should have. And I think of those 4 categories, and the stock we're going to talk about falls into one of these, the ones that we sell too soon are probably the biggest mistakes, because if you can buy a company that goes up 4,000%, as Cochlear would have done had we hung on to it instead of buying and selling it twice, you would have just done far, far better than buying and selling on the way up, even if you could get that timing right, which nobody can. So there's a kind of compounding effect from just hanging on. And I think in investing, the fewer decisions you make, the better off you'll be. I don't know whether you guys agree with that, but that's where I've landed with all of this. Do you want to try and the big decision is buying a good business at an attractive price. If you can minimize your decisions thereafter, you're probably going to be you'll do really well. And the best way of doing that is to focus on your mistakes. And one of the biggest mistakes is selling good stocks too early. I think that's our biggest mistake in the past over the past 25 years.
Yeah, unquestionably. Let me put it another way to you. A friend of mine has recently blown my mind with a very simple kind of analogy. Greg Hoffman, who's many listeners will know, former research director, often distraction, but also mentor to all of us. He said to me that, investors focus so much on the R, the rate of return. Mm-hmm. When you think about your return, the mathematical equation for a return is the R to the power of T, return to the power of time. The exponential component, the thing that makes the big difference, is not the R, but the time. Yeah. And so investors probably focus too much on the return and not enough on the time to allow compounding to happen.
Absolutely correct.
I
wouldn't put that equation in the book. Greg can keep that. It's really going to turn people off, but it's right.
Yes. This makes it so clear, doesn't it? That there are two things to think about. We only think about one of them, and we let the other kind of happen. But the second one has a bigger impact on the first. The time matters more than the return.
Yeah.
It's had a groundbreaking
see that in the comments change to the story that we published. We could look back and Cochlear and say we actually did a pretty good job there. We recommended that at I think it was around $6 maybe, $6.30 in mid 1998, and we sold out in 2002 at about $41. And then, this is kind of mad that we actually managed to do this, but we bought back in after it had fallen by about 50%. So we bought back in at $20 in 2003, and then we sold out again in 2015. And so in that first trade, we made 600%. In the second trade, we made over 300%. And I think that was part of our problem. We got a bit too confident with that stock about being able to pick what the intrinsic value was. And we consistently underrated it. Had we just hung on after that first purchase, we'd have been far better off. And you can see in the comments of the Cochlear story, a lot of members did exactly that. They made fewer decisions. They just bought it and held on. They were the two decisions they made. And they're just in a far, far better position than what our official recommendations were, having sold quite successfully twice.
It's a really tricky thing, John, because we're all kind of taught, and the correct decision is actually to sell a stock when it becomes too expensive and not to let it get too weighty in your portfolio. But, we talk about this sometimes internally, but I think those rules, those correct rules, are rules really for beginners. And as you get more advanced in investing, once you get good at it, the understanding of when to break rules is how you make big returns. And I'd suggest that holding stocks for a longer time, and not worrying so much about the portfolio allocation, how much, if it's more than 10% of your portfolio, those are rules worth breaking. And you just got to be experienced to know when the time is right to break those rules.
All right. So I think this is an interesting area. It's probably worth a story in itself.
Yeah.
How would you know, how would our members know when they're at the point that they feel as though they can wear holding, let's say Lavisa, which is probably a big part of people's portfolios now. It's probably, I don't know what our portfolio allocation limit is on it. It's probably only 5% or so.
Well, let me illustrate this. It is 5% officially.
I'm not sure I want to hear this, Gaurav.
And I think it's 22% of my own portfolio.
Right.
And I have no intention of selling.
Okay.
And I have not sold a single stock a single share since I bought it, and it'd be crazy to do it.
Okay. So what do you think that members should know from your experience of hanging on to, I know you had a really big position in coal and the same thing happened there. What was it that gave you the confidence to hang on? And how do our members know when they're experienced enough to go beyond those limits that we set in the publication?
Yeah. The limits we have to set, because we catered to a wide variety of ability levels, of risk tolerances. So I think that's the right move. In the publication, we do have to be sensible. We do have to follow the rules, and then individuals have to decide when to break them. For me, there are two triggers for breaking rules. One is I set myself up so I'm never a forced seller. So don't take margin loans. Make sure you're not geared up in your portfolio so you can handle volatility. So at no point will I be a forced seller of something. And then the second is you get your confidence from the work. I mean, Lovisa is a simple business. Coal was a simple business, but I feel as though I did so much work on both of those. Coal was just a massive deep dive. I've held Lovisa for a good part of 5 years, and I think I understand that business really well. And so it's that familiarity and the comfort. That's what breeds the comfort with the business. I would struggle to buy 10 or 20% of a brand new position that I wasn't familiar with. But once you know a business really well and you can sort of see out its trajectory, you're not levered, and you're not going to be a forced seller, and so you don't have any financial constraints that way. I think that makes it easier to hold chunky weightings. I think a bit of experience as well. The analysis in investing is actually the easy part. It's always the psychology.
I was going to ask you about that, because let's imagine that Lovisa fell back down to, say, I don't know, $15, $12, which you could quite easily do in a recession. I think it's quite possible that stock could get absolutely hammered. If that happened, what would your reaction to it be?
Well, it depends on the reason. So if Brett Blundy was selling shares, I probably would exit my position. If they suddenly close 50, 60 stores in the US, I'd probably sell my position. But if they've just had a poor quarter, even a poor year, I'm okay with that.
There was a recession and they got their product lines wrong.
That's fine. Well, we've seen big drawdowns in Lovisa. I mean, it was over $30 this time last year, and then it fell to $18, $17 towards the end of last year. I increased my position a lot. In the pandemic, it got down to below $3. I think from over $10 down to $3. And again, I was buying on the way down as well. I remember one day I bought at sort of $4, and the very next day it fell by 60% or something.
See, I think this is when you talk about experience. It's that kind of experience that tempers you. So if you know the business well, or you think to know the business well, that's only one part of the equation. If you don't feel as though you can handle those kind of share price falls, you really should be sticking to the portfolio limits. Yeah,
I think that's right.
I think you also need to be just absolutely certain of your confidence in management if you're going to hold over that kind of percentage, because you're really entrusting a very large part of your portfolio to a single individual or a small group of managers. And so if you think a company is undervalued or has a good runway or something like that, but you're a little bit uncertain about management, or you don't know management very well in terms of their history, then I think you've got to stick extra careful to portfolio limits in that case.
That's a really good point, actually. Not every position is worth taking a huge punt on. You've got to really pick those few stocks up. I've only had a handful of positions that are more than 10% ever. I Coal, Lovisa, and at the moment, Minres is a big position for me. But it's rare to have confidence in a stock to take a massive position. I think the ability to exercise that kind of constraint to know when to go big and when to go small.
But even with, say, if you compare, say, three completely different businesses, Cochlear, Lovisa, and Minres,
Yep.
and I know we've got a huge amount of hindsight bias there, but I would be less confident holding a bigger percentage of my portfolio in Lovisa and Minres than I would Cochlear. Cochlear, I think, is just Minres has problems in that it's very much dependent on commodity prices, and lots of things can go wrong in that business. You've got Lovisa being highly exposed to, the consumer spending cycle. It's in a massive rollout. Things can go really wrong in massive rollouts. And I know Cochlear had those moments where it did fall by 50%. But to me, the technology, because it's a technology-based business, just gives you a much more stable foundation that can give you a little bit more assurance that if it does get to 20 or 30% of your portfolio, it probably will recover at some point if it goes through one of those big drawdown periods.
Yeah, and it's a much slower moving business than the other two. So things can creep up on it that do end up causing issues. Like you couldn't guarantee that Cochlear will be the number one in 30 years or so. Something else could come along that kind of displaces it in technology, but that's not going to happen overnight. Whereas I feel like something like Lovisa, maybe less so Minres, but yes, a faster moving business is just more prone to those kind of explosive movements in sales. Whereas Cochlear, I don't think it could really do that.
The other thing I'd point to
especially now, maybe 10 or 20 years ago, it would have been more able to. But these days, it has such a large services business and there's such a big installed base that it's going to be selling to people there for the next 40 years, no matter what happens to its new sales. So, I think that does give it a level of stability that allows a bit more confidence in it long term.
True.
And balance sheets, I would say as well. I mean, I would not have gone that hard on Lovisa had it not been net cash. And if they had financial debt going into the pandemic, I probably would have sold out or entirely. And it was the fact that there was net cash that gave me a lot of confidence as well. Which is why.
Do you think of lease liabilities the same as net debt?
Well, not really, no, because a net debt can be called in all at once, and lease liabilities are kind of drip fed. And then during the pandemic, there was agreements and there was adjustments made to leases as well, which debt isn't as flexible as that.
No,
debt is
that's
really really
covenants
insidious.
too.
Yeah. You got to be very careful. I mean, Minres is holding a fair bit of debt now, probably more their debt than they have ever had. And that's what's stopping me from putting sort of 20% position in. But they do have assets backing that debt, and you can sort of see a pathway to, if all that debt came due tomorrow, you couldn't see a pathway of them repaying it with asset sales, lower capex, things like that. So that provides some comfort as well.
Yeah. It is funny how we can start talking about Cochlear and end up on Minres or Lovisa.
That is funny. Well, I suppose the discussion really wasn't about the business. It was really about that very interesting trajectory of buys and sells.
That's right. When to sell or whether you should at all.
The other thing that we don't talk about much is tax. And someone actually mentioned this in the comments. I thought it was a really good point to mention. Is that every time you sell, that's when you realize a tax liability.
Yeah, it can reduce your compounding by 15 or 30% a year.
Yeah, makes a big difference to your compounding. That's correct. Yeah,
and then you've got to go and find another stock in which to invest it at similar rates, plus the tax that you just paid.
That's right. Yeah, yeah. For me, I am trying to make fewer decisions and buy stocks that I can hold for long periods of time, even if that is at a lower rate of return.
I think it's also just a more peaceful life. I do the same, really, and it's much more. I don't know. I sleep much better not having to constantly, overthink sell decisions as much. If you're more comfortable just holding, thinking, look, I'm going to hold onto this for 20 years. What happens to the stock today just doesn't matter very much. If there's some small release that comes out that makes you question it, like if your default is to just hold unless it's something, I don't know, really disruptive that you need to get out for, then that just allows you to take these small blows into proportion.
Let me ask you that then in context of Ordinate, which has gone up, 4 or 5 times since we first recommended it a few years ago, probably 4 or 5 years ago now.
Actually, I think it's gone up almost tenfold.
Tenfold, yeah.
Almost, yes.
Because Cochlear might not have looked so different to Ordinate maybe 20 years ago, deeply sort of technology kind of business with a potential monopoly, incredible technology. Maybe we're at a point with Ordinate now that Cochlear was in, 2000, something like that. How would you approach Ordinate now in terms of your portfolio allocations? Because, it really is creeping up pretty quickly in terms of portfolio allocation. I did sell some down a month or 2 back. What do you guys feel about that?
Yeah, I'm not sure. They do have some similarities, so I can see your point. At the same time, something about Cochlear's kind of innovation cycle seems a bit more comforting to me, that I can't imagine something suddenly, like there is just zero chance of a new competitor disrupting it in a year or something or other. Whereas Ordinate, maybe I just don't know the business well enough, but that doesn't sound, I don't know, would you say that that's the case for Ordinate as well? Is there any disruptive force that could, in 5 years, really make an impact to it?
Possibly, but there's a network effect there that I think Cochlear doesn't have.
Yeah, that's true too. Yeah, they're different, but I can...
it's a tricky one. I think the valuation is far more extreme in Ordinate than it ever was for Cochlear as well.
Yeah.
That's a good point. Yeah. The valuation does make a big difference for if you're allowing a large a large portfolio position and it's got a huge valuation as well. I mean, people's valuations can change a lot quicker than in terms of the market. The market's valuation can change a lot quicker than the business underlying it. So even if we think that Ordinate's got this fantastic runway, can't be dislodged and all of that, if you're paying a ridiculous multiple for it, it doesn't take much more than a sneeze for that to go down 25% in a mood change.
Oh, totally. More possibly.
Yeah. You got to be a bit careful with Ordinate. Its potential is immense, and it could very well be a monopolist in the future. But it's a $2 billion business or something now. Makes $20 million a year. You just got to be a bit careful, because the monopoly profits are well and truly starting to be priced in. Now they could be much, much higher, I think, than the current price implies. But they also could. There's a chance that it might not happen too. So I don't mind your decision there, John, of taking some profits. This is probably not one that you'd sit on a 20% portfolio limit and ride out through ups and downs. So I think Coordinate's a little bit different.
Yeah, I'm glad.
But having said that, I've got a chunky position in it myself, and I haven't sold yet. But so it's a harder one. It's a tricky one.
You'll have to keep trimming your 50% position, John.
All right, look, we should probably move on to another stock now. Graham, you've got an interesting one. Let's do one of yours, Graham. Which one do you want to talk about?
Let's do Domino's. Domino's. Yeah. Mm-hmm. Who doesn't like Domino's?
Yeah, okay. So we actually recently sold this out of the funds. I no longer hold Domino's. I find it amazing that at one point I was sitting on I think a 600% gain or something on Domino's, and I ended up selling it for like a 10% profit or something like that. I don't own it anymore. I've lost a bit of confidence in that business, Graham. What do you reckon? What do you reckon I should have done?
Was that after the 600 gain fell to 10%? Or?
Yes, that's exactly right. That's after the...
That's what blew up the confidence.
All the way
That'll
down.
do it. I've done the same.
It was, for me, it was actually... the issue was when I started thinking a bit more deeply about that business. I'm really happy with the Australian business. There are parts of Europe I think can work really, really well. But it's Japan where they've... which was really responsible. It was at one point it was the most profitable territory, so it was a huge part of the valuation. And I'm not convinced that Japan is a territory that can work, and they're pouring lots of resources into it. And they're a territory similar to Japan, Taiwan, Hong Kong, with similar problems, which is that people live in these tiny, tiny apartments. There's a huge existing competitive base of restaurants, and the culture is really to go out and eat, not to bring food into the house and eat. And changing that culture is just it's going to be really difficult. And I think what we saw in 2020, 2021 was just a one-off change in consumer behavior brought about by the pandemic. And the collapse of the Japanese sales is probably normal. So once you run normalized Japanese sales through there, I think it's a harder thing to do. The balance sheet worries me a bit. As I said, I think debt is really, really important. If you've got debt on balance sheet, then any problem gets magnified. So, and management as well don't seem as though they are they're accepting some of the stuff that I've come to accept about Domino's, and they're
that's what kind of worries me a little bit, is that management still seem very optimistic. They haven't changed any of their targets, any of their like store count goalposts or anything like that. And I'm just kind of waiting for the day. Even if I think that for the long term, this is a pretty good company, that like it probably still does have a decent kind of growth outlook. But the next couple of years, maybe even in the next year, I just think it's very likely management come out and have to roll back their growth assumptions. Once the management does that, then the stock always just plummets because everyone just loses a bit of confidence in what management has said previously.
So, Graham, are you concerned about Domino's at this price, or are you concerned about the business regardless of price?
My concern at this price is that, particularly in the last result, you see the kind of average franchisee bringing in much lower operating profits per store. It's down, I don't know, like 40% or something in the last few years. That then extends the payback period that a new franchisee has to take on in order to kind of recoup their investment when starting up a new store. And so with those two things, what I expect is going to happen is that the company just won't meet its targets for the rollout. And if you've got management saying they're going to open 200, 300 stores a year, and suddenly that has to drop down to 100 or something or other, keeping in mind that in Japan, it only opened 10 this past half, so we're way off what management have said that they want to do. I just can read an announcement now in my head that's going to come out at some point where they just have to roll back those assumptions. And once that happens, then you start having to push out like future profits and all of that kind of thing. There's going to be slower profits from operating leverage and all of this. And suddenly, you do wind up with a much lower multiple, or the stock deserving a much lower multiple than it's on today. So
I completely agree.
Yeah.
That's right, Mike. And I think in addition to that, you then also risk, I think Don May's days, well, they're not numbered, but geez, he's in a precarious position. Because I think if that happens, if they have to roll back their growth assumptions, his position starts to be in question. He's been an outstanding CEO.
It would be a shame of an end. Yeah, it would be sad if that's what ended up booting him out after hitting some turbulence like this, which is really just a matter of overconfidence, I think.
And you can understand where they came from because they were printing amazing numbers.
Yeah, and deserved probably.
yeah, that's right.
But yeah, Japan worries me a bit. Europe doesn't worry me too much. I think that there is still, I mean, the density of stores there is way below Australia. And although I think there are some differences in the culture over there, particularly grocery store prices are much lower there, which makes eating in a lot cheaper. So kind of Domino's has a competitor in that. I think there are some differences between the European and the Australian market, but it still seems like there's a pretty good runway there. But yeah, for the reasons you said, Japan is quite different. And then with that falling profitability, I think that changes it quite a bit.
I also couldn't help but think about, because I sold Domino's at the time to put more money into La Visa. And to make that decision, I was comparing the two businesses a little bit, and just it is a retail. Domino's is kind of a retailer, but it's also it's a franchise business. So a lot of fees get bled back to the master franchisee. It's a lot of its destiny it's not in complete control about. it's just another added layer of risk and complexity that a wholly owned brand does not have. And that was actually one of the things that really got me to make that switch. I do like Domino's. I think it's a wonderfully managed business. The economics are sensational. The Australian business is just fantastic, isn't it, Graham? I mean, it's a wonderful business here locally. But yeah, I share your concerns about the growth and just some of the complexities with having that franchise model. Is also as other investments don't necessarily have that.
Yeah, I think franchisees tend to. They're almost just a way of leveraging a good retail rollout. That when they work really well, as it had for Domino's for many years. Yeah. But yeah, you're also competing for new franchisees versus all the other franchise stores that they could be opening. And so when things aren't going great, that can unwind a lot quicker, I think.
John, have you ever bought this one?
No, I haven't. It never really attracted me, I suppose. I think it's a really competitive market. There's two different kinds of business models in it. And I know they're exceptionally managed and they make great returns. And they do. But, in terms of a retailer, I suppose, fast food is retailing in many ways. It's easier for me to understand something like Lovisa and the fact that, you can roll out your store network and do that and still pay a 2% dividend yield just makes it so much more attractive than something
3%,
like
John. 3%.
3%, sorry. That is incredible, isn't it?
Isn't that incredible?
Yeah. So any company against that is going to struggle, I think. But yeah, Domino's just I was never really attracted to it.
It's interesting. I think that full year result is going to be one to watch, Graham, and also the AGM. AGM is probably one I'm looking forward to. Try and get down to that one.
Maybe that would be where they make the announcement, if they do make an announcement to roll things back.
Yes. We'll have to see. But it's interesting. It's a good example of when, we always say that if the share price comes down, we'll buy it. But we just got to be mindful that market's not stupid, that share prices react to events, and the event is probably just as important as the price. And
you see that. I see that all the time where something negative. This is one of our difficulties, I think, as analysts, is a negative event occurs, the stock then drops, but almost in a perfect proportion to what you would estimate the damage to be. So you're still no less over or undervalued at the new price. And it's well, I still think we should hold. It's kind of discounted the problems.
Yeah.
I think that's when we revert to the long term. That's why the T is so important. You can look through short-term moves. I think one that you were talking about, Graham, and was JB Hi-Fi when it got cheap. I remember you kind of brought that up, and me chiefly, but others also just poo-pooed that idea. And I think that's a fantastic example of what you're talking about. It was very clear that margins were going to fall in that business, and because of that, I didn't want to buy it. But the market had already anticipated that, and I think it adequately priced it for the margin fall. So. Once that was done, it's up 50% or something from when you were talking about it. It's been an expensive miss, but highlights the difficulty in trying to catch some of these things.
Yeah.
Right. Gentlemen, I think we should probably call it. What do you reckon? Anything else?
I think so. Yeah, we've been going 40 minutes.
I know. It's mostly your fault, John, with Cochlear. What a fascinating book it's going to be. Filled with all
I don't know about that. I'll let other people judge that. I'm just trying to concentrate on finishing it.
Well, a couple of those big errors have been mine, so I'd like to think I've contributed in some way.
Oh, we've all made some very, very valuable contributions, believe me.
Can you give us a sneak peek into what the next error will be?
Well, I think in terms of Cochlear, I think we underestimated intrinsic value. I think that we were overconfident because we got it right the first time, and that made us confident we would get it right the second, and that led to that second mistake. I would say that there's a psychological issue there, and then there's a fundamental issue there in underestimating the value.
Yeah. And in terms of another stock mistake?
Oh, there are so many. Well, I think these are the hard ones that you sell too early. You can look back on, say, a Mason or PMP and just say, we shouldn't have got involved in those companies. They're just the quality of the business model.
Sorry, I have an allergic reaction every time you mention those two stocks.
Yeah, I mean, I have just Mason's been. Gaurav and I have spoken about it a number of times, but
many times.
It's kind of fascinating when you look at it. You can see that. Well, it's just a really, really hard business being a reseller. And you can get to Dickadata's size and experience and do well from it. But when somebody like David Teo comes in and just dumps a $10 plan with 10 gigabytes of data on you and you're charging 30 or 40, you just blew a Mason out of the water straight away with that one move, and that was it. And that's when we got out. But actually there were signs before then, I think, Gaurav.
Absolutely.
That we should have got out, because I think management knew it was coming, which is why they got into energy, reselling energy, 100%. And we probably should have got out when the business model changed.
That was it, John. That you've absolutely nailed it. That was the moment to sell. I don't think buying that stock was the error. The error there was a massive red flag that went up, and we should have. You know what it is, John? As value investors, again, the way we're trained and we're taught that, we sit here and we endure the pain. We're not the flighty momentum traders who first sign of trouble, we're out. I've disavowed all of that. I panic quick when something changes. My first reaction is
panic quick, panic hard.
Panic quick and panic hard. And I think that's the right call. I've saved myself a lot of headache from just taking it, taking the hit. And you can always buy back in later if that's what you need to do. But the first reaction for me is, right, just sell and get out. Removes any psychological bias, and then take a look at it.
Right. Yeah. And so many times when you do that, you just go, wow, I'm so glad I did that.
Absolutely. An example of that I'll throw out was, what was that stupid AMA, that AMA business, right? So it's a panel beater, and they made a big acquisition, and I had fought for it to be on the buy list, and it was a buy. And then all of a sudden, the chief executive was fighting with the board, and he abruptly left. And he wrote this letter slamming the chair. And when you think about it, that doesn't impact the valuation of the business. If you put together a discounted cash flow, what the CEO and the chair say to each other, how cordial they are, whether they use polite language, that matters nothing to the DCF. So, in a logical way, the correct decision would be to do nothing in that case. But I went in full panic mode. I was like, it is never a good thing to see the CEO and the chair arguing. When the CEO abruptly leaves, that is a trigger for a sell. And so I sold that stock immediately. And that was about 80 cents. And it is now languishing at about 4 cents. And I think it's going to go bust because they're trying to raise capital at sort of less than 4 cents. And I don't think they're going to. And that saved us a world of pain.
If there's one big problem in a business, it's rare that it's only one big problem.
The last place it turns up is in the financials. You've got to be looking elsewhere to spot these problems. Right. And if you see it in the numbers, you're too late.
Yeah, it's gone by then.
It's gone. That's it.
I mean, I think there's I've been working with Nick on his Boeing story, and that's a good example of a culture that's just been lost over a period of 20 years, I think. And you can say, we could buy back in now. It looks cheap. The price is down 50%. There's always going to be two big airline manufacturers. There has to be. They split their orders between planes because they want two companies making airplanes rather than one. Exactly. It's going to survive. But do you want to go in there and run the risk of even more planes having more problems because the problems they've got clearly haven't been solved? Just don't want to get involved in something like that, I think.
All right, gents, we have been talking for a while. I think we better give the good people their time back, and we better go do some work ourselves when it comes to that. If you're interested in the work we do, you can go to intelligentinvestor.com.au, where we have much more formalized, and I would say equally sensible ideas you can rummage through. But for now, that's it. John, thanks very much for joining us.
Thank you.
Graham, thank you for your time.
Thanks, Gaurav.
And for everyone else, thanks for listening.